Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
Good morning, everyone, and welcome back to Wealth Coffee Chats, and welcome to a brand new week. Bob Proven here, one of the advisors at Positive. Before we get into it today, where are you joining me from on this beautiful Monday? I'm up in the beautiful Mildura in the northwest corner of Victoria. So good to see if people can jump in the chat and let me know where you're joining me from today. Okay, so today I want to dig into a question that I'm talking about a lot with my clients recently. And that is, should you purchase a positively geared property or should you purchase a capital growth property? Now, this is one of the biggest decisions and one of the biggest points investors face, and it has a massive impact on how fast your portfolio grows and how quickly you can reach financial freedom. So let's break it down visually today, and we'll have a look at each option and see how that really affects your long-term results. So let me share my screen with you. Okay, so on the screen here, you will see two property examples. We've got option 1 and we have option 2. Which property would you rather have in your portfolio? Would you rather have option 1 or would you rather have option 2? Now, most people would say option 1, and here's why. So when we simplify properties and when we're investing in properties, we can break them down into 3 very sort of broad categories. Now, what those categories are is we have an A-grade property, which the expected growth is above market at 7%. We have a B grade property, which grows at the market rate of 5%. And we have a C grade property, which grows below the market rate at 3%. So our A grade property, if it grows at 7% each year, it will double in value in 10.2 years. Our B grade property will double in value in 14.4 years if it grows at 5%. And our C grade property, if it grows at 3%, will double in value in 22.4 years. So the growth rate is that real difference. And that's what affects everything from equity to borrowing power to how fast you can actually scale your portfolio. Now let's walk through these two property examples. So what I've got here is some amazing spreadsheets that we have for our clients. So option 2 is that C grade property. Option 2 is the established property. It's ready to rent immediately, and the numbers do look great at first glance. So we've got a $37, if we go over to this, so we've bought it for $445, $115, $822 is the deposit. We've got a $37 positively geared before tax, and we have $26 positively geared after tax. And we have a rental yield of 6.6%. So yes, the cash flow feels nice, but because this is the C grade property, it's growing at that 3% rate each year. So after 1 year, the property's grown from $445,000 to $458,350. When we add the after-tax cash flow and the capital growth, we've made $14,724 in year 1. Now, the tenant has effectively covered 107% of the expenses for the property, and we as the investor have to pay back 2% to the taxman. So far so good, but let's break this down and we're going to move forward a little bit as well. Good morning, Caroline. So yes, let's move forward here. Let's go 2 years into the future. This property is, we've made, what have we got here? We have $69,890 of usable equity. So not quite enough for another deposit for another investment property. We don't actually reach our initial deposit amount of $115,822 in equity until year 6. So that means that we are going to wait 6 years before we can leverage this into another property. And now after 10 years, this property is worth $598,043. So after 16 years, we might have been able to buy 3 C grade properties in total. And if all 3 of those properties that we've been able to purchase continue growing at that 3% per year rate, then the portfolio will be worth around $1.7 million, and it'll be producing $85,000 worth of passive income if it's debt-free, which is not bad, right? Now let's compare this to option 1. Now we remember what option 1 was. Option 1 was our newer property here. So option 1 is a brand new house and land package. So there's a 6 to 9 month build time for that, and then the tenants can move in. And yes, it is negatively geared. So we are paying $184 a week before tax, and we are paying $16 a week after tax. Now, at this point, a lot of investors will say, negative cash flow, I don't want that. I want positively geared. But this is where the magic of capital growth really kicks in, because this is an A grade property, it's actually going to grow at 7% per year. So what that looks like, after 1 year, it's gone from $700,000 to now being worth $749,000. Now, when we add the after-tax cash flow and capital growth together, when we've done that, we've made $48,190 in year 1. The tenant has paid for 75% of that property. The taxman has paid for 23% of that property, and we have only actually had to pay 2% for that property, which is a big difference already. So let's fast forward again. After 2 years, we have got $159,287 worth of usable equity. which is enough for another deposit for another A-grade property. So no waiting until year 6, unlike the C-grade property. We can leverage that again right away, essentially. Now, after 6 years, we have $383,460 in available equity, which allows us to potentially purchase another A-grade property. So we've been able to leverage into 2 more A-grade properties with this one. So after 10 years, this property alone is worth $1.377 million. Now, after 16 years, if we now own the 3 A-grade investment properties and they've all grown at 7% per year, that portfolio will pass $4 million and will be producing $200,000 worth of passive income that's going to be all ours once it's debt-free. So by choosing that growth-focused strategy and then paying $16 a week extra after tax, we've potentially built a portfolio worth $2.3 million more than what we would have if we were focusing on properties just because they're positively geared. So one small cash flow sacrifice can make us millions of dollars in the long term. So it's that long-term reward that we're looking for. Now, everybody's situation is different. Cash flow absolutely matters, but positively geared properties are not the magic shortcut that the internet makes you believe that they are. Okay, so if your goal is wealth, choices, freedom, early retirement, a legacy for your family, then the question isn't which property gives me the best cash flow this year. The question is which property gives me the ability to build the biggest, safest, fastest growing portfolio over time. Because capital growth properties do that, and cash flow keeps you in the game. Capital growth gets you out of the rat race. So before you choose a positively geared property, just because it shows a few dollars a week of surplus on paper, make sure that the long-term numbers actually match your long-term goal. Okay, so thank you very much for joining me. I'm Bob Provan, and it has been another beautiful Wealth Coffee Chat with you this morning. Now, until next time, don't just work for your money, build the assets and make your money work for you. See you later.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6 Star team here at positivementor.com.au.